Hey, good evening, everyone. We're real excited to have y'all on here tonight. The world is still crazy, of course, but thank the Lord for technology. So me and Mr. Barry are real excited you're with us tonight to discuss a topic that not many people enjoy talking about, but one that is extremely important and one that we're very passionate about. So thank y'all again for hopping on here. And I want Mr. Barry to do a brief opening, and he wants to welcome everybody as well.
Thank you, Reid. I do want to say hello to everybody. I've gotten to the point I really enjoy this on Thursday nights. I feel like it's a way that we get to stay in touch with a lot of people and our clients, especially since people are sitting home and you got nothing else to do. I really will say this too. This webinar is going to be very, very special because it's an issue that we all need to face. You know, if we live long enough, we're going to become frail, or we're going to basically lose our mind from dementia or Alzheimer's. Before Reid and I really dive into that, I really kind of like giving you an update about really kind of what's going on in the economy. And so I always have a few opening remarks that I want to go into at this point in time. This week has been absolutely crazy. You know, we're seeing the unemployment numbers continue to rise. I read in the Wall Street Journal this week that Nissan and Honda has furloughed 24,000 employees. I think we've got over 10 million people that have filed for unemployment benefits. And what's absolutely crazy is the extreme market volatility that we're seeing, Reid. I mean, the S&P and the Dow, those two indices for the week are up about 10%. And, you know, there's some people that are pretty excited and they're like, whoa, this is awesome. We're roaring back. But please remember that the market still for the year is down 15%. And I want you to understand kind of what's going on with the marketplace. Why has the market done very well this week? Well, most economists and everything that I'm reading, there's a few factors that are coming into play here. Number one is that we really believe that social distancing is really working. We're seeing the pandemic. We're seeing the numbers in New York in terms of people being admitted to the hospital. We're seeing those numbers go down. A lot of the task force with this COVID-19 believes that we're really at the apex of this thing, and the next week or two is really going to be very crucial. We're seeing a lot of deaths right now, but hopefully we're seeing that the numbers are going to start going down. So what we're doing from social distancing is working. Wall Street is loving that, but also what they're loving too, and not to be political here, but this is really how it works, is that Bernie Sanders, you know, has decided to drop out of the presidential race. And he is no friend of Wall Street or corporate America. And I don't mean that negative, but this is how Wall Street and corporations look at that, because Bernie is about government regulation and Trump has come in with his presidency. And what you saw him slashing regulations and red tape in order to let the small business owner in order to run their business without the government being so intrusive. So with everything that we're seeing, you know, most economists by far still think that the recession, that we're going to go into a recession, that's going to be imminent. And, you know, you think about it, our economy is shut down. People are not working. We are still not going to know the real ramifications of this probably until about 6 months later. You know, we're seeing the government throw a lot of stimulus money at this, and there's so many people who need it. Small business owners need some of these loans that they have. So we've got a long way to go. But, you know, it's like I've said in many of these webinar sessions, you know, we're in a storm. But from right now, from my perspective, it's like we can see through the clouds a little bit, and we see the sun light out there. And I began thinking this morning that we had a downpour this morning, and think about it, the best, most beautiful rainbows come after the storm or the rain. And see, I think that's God's purpose too. I think God's going to do this, that he's going to use this pandemic, that he's going to illuminate himself, and there's going to be a lot of miracles that are going to happen, that have already happened, Reid, that are going to happen, you know, from all of this. So one thing I would just challenge everybody to please do, keep praying, pray for this great nation, pray for, our first responders, for our nurses and our doctors. Those are some incredible people. I have a daughter, I said this before, who's at MUSC. These people are putting it all on the line to take care of people. And, lift it up in prayer. God's got this. His timing is perfect. Ours is not. And, we will go through it. And I really believe that we're all going to be better from it, Reid. And I think God's blessings are going to still pour out on this great nation.
Amen. Amen. I totally believe that too. So we'll jump into this long-term care presentation. And once again, we're excited to have everyone on here tonight. When I came out of college, I had no idea that just in 6 years I'd be doing presentations on long-term care. I had no idea I'd be talking about Medicare, which is coming up in a couple weeks. But what important things, especially with the 3,000 amazing clients that we have that are 65 and older. So we're going to talk a lot about this stuff because it is very confusing. And we always like to start these with some of the favorite verses that we have, because we are praying for everyone. These are unprecedented times, as we've heard that word unprecedented countless of times the last few weeks. In John 14:27, peace is what I leave with you. It is my own peace I give you. That's what's amazing, because the world cannot give you the peace that Jesus Christ can give you. Timothy 1:7.
By the way, Reid, the world can't take away that peace either.
Amen. Yes, sir. Amen. So Timothy 1:7. For God has not given us a spirit of fear, but of power and of love and of a sound mind. So when I feel the fear, I know that's not from the Lord. In Deuteronomy 31:6, be strong and courageous. Do not be afraid or terrified because of them. For the Lord your God goes with you. He will never leave you nor forsake you. So no matter what you're going through right now, God's got it, which Mr. Barry does a great job of telling our whole team here at Barry Financial that God is in control, and what a blessing that is. And then, of course, we always go into the disclosures. This picture, I want to start off. You didn't save anything for retirement, did you? Now, this is a pretty humorous picture. Mr. Barry, that may be you one day.
It very well could be me, Reid. I'm not going to say anything else about that, my friend.
We'll leave that there. We'll leave that there. And this picture says a lot, though, because when you really look at what this picture is saying, yes, it's a little bit humorous, but it's also a little bit scary. Because what you're seeing on this gentleman's face, he's thinking, oh my goodness, how did I get here? He's also thinking that he can't get up. And then his wife is looking at him like, uh-oh, what are we going to do? And she starts saying to herself, hey, where's the money going to come from? Because I sure can't do it myself. He sure can't get up himself. And so she's asking him, you didn't save anything for retirement, did you?
A little bit of humor goes a long way, Reid.
No doubt about it.
The world needs to laugh.
The three biggest risks that we feel pre-retirees and retirees face, the first is the stock market risk. Mr. Barry, why do you believe that this is the most or the biggest risk that retirees face?
I've said this forever, and I really practice this with our clients, Reid, is that, a lot of people can overcome market volatility, but you've got to be at the right age. When you look at our clientele, Reid, our average client is 65. It could take 10 years to have a true recovery. Our clients don't have that time. It's not to say they may not live long enough to have the time, but if they have to wait and go to a holding pattern and hold their positions and wait for it to come back, they just miss the best years of their retirement years. So market risk, it can, what it can do is absolutely destroy a retirement nest egg. Because if you're currently right now, if you don't have any type of pensions and you've got a 401k or retirement account and you're taking distributions in a downward market now. The market's down 15%. And so what you're doing, you're actually locking in your losses, Reid, that you can never get back.
So true. And those, the market just wiping away a lot of your monies really affects every part of your retirement. The second biggest risk we see is longevity risk. which is actually a risk multiplier. So for somebody who retires at 60 and then goes to meet Jesus in heaven at 63, they didn't really have a whole lot of time to see a lot of market risk or to get really frail or to have a big health issue. However, for the person that lives into their low 90s or even upper 90s or low 100s, if you're 60, do you think if you live to be 100 that you're going to see some market volatility?
No doubt about it. And you got to have that money still working for you too, because inflation is an issue too, Reid.
Exactly. So the longer you live, the more risk that you actually face. And then, of course, the third biggest risk is the healthcare risk. What does long-term care mean to you? Mr. Berry, this is a very, very important question. And what do you think long-term care means to you?
Well, I can get very personal with this. First of all, when I really thought about long-term care, and when you asked me that question, straight up, what it really means is that it's basically a financial, an emotional, and physical disaster for most people. And I think this is very important for us to educate people about this, because I've gone through this with my parents. And Reid, if it's okay, I'm going to share a little bit about my story.
Yes, sir.
Here. To tell you, take everybody back, if you go back to the year 2000, I had been in my career for about just a few years, and I was building the business. My mother, at the age of 61, was diagnosed with terminal cancer. So she had lung cancer. It had metastasized into her liver. And basically, we were, she was stage 4. And we were taught that, okay, we're going to put her on radiation, we're going to put her on chemo, and this should extend her quality of life. But my lovely, incredible wife said, hey, Richard, don't worry about your mom. I'll take care of her. So Jan began taking care of my mother, but understand what came along with that. We had, 3 small children at the time. Jan was, I think, in her late 30s at this time. But also what came along with my mother was my dad. My dad was 79 at the time. He was a diabetic and he was legally blind. Okay. So she took care of both of them. Both of my parents ended up passing away about 15 months later. But let me just tell you something, Reid. It was one of the most brutal things that you can go through as a family. For some reason, people think that brings families together. No, it doesn't. There's a lot of hardships there. I'm so thankful for my wife, because both of my parents got to die in their home and in their bed. And my wife made that possible for them to do that, because all the viewers, Reid, if they really think about this, if you have a choice to decide where you get to die, almost every viewer would say at home. Okay, that's where we feel the most secure. That's where we typically feel the most peace when we're at home, because we know our environment. And I'm happy to say that that's where my parents, both of them, died. But listen, it took my wife, after both of my parents died, about 1.5 years physically to recover from that. It is that brutal. And what we're going to talk about long-term care, why it's so important, and I want everybody to get this. I don't think you could do it for this reason. I don't think long-term care is an issue, a monetary issue, that you just make a decision just to protect your money. The reason I bought long-term care after my parents died, I bought it at age 48. So I've had it for about, I'm 55. I've had it for 7 years, okay? The reason I bought long-term care is this reason. I don't want my family to have to put their life on hold, Reid, to have to worry about taking care of Jan or myself. And I don't want my wife to try to have to lift me either. To be more blunt about it, I don't want my daughter to wipe my behind. You think about that. And I want guys to understand, God made men and women very different. Women are some of the most incredible caregivers. They're servers. Most men are hunters and gatherers. We like to puff out our chest. I want everybody to think about how difficult that would have been if I, Reid, would have had to take care of my mother. What if I had to bathe my mother, change my mother? That would have been very uncomfortable and difficult for me. So I was so blessed that I had a wife who stepped up to the plate and did it. That's why I think this is so important, what we're going to cover tonight about long-term care.
Wow, such a powerful message. And when I first heard that, I really understood the importance of it. For if you would have had somebody in the planning, if your parents would have had the planning, if it were a thing way back when too, that would have really relieved Mrs. Berry a lot.
No doubt.
And so a question we always ask, do you think there's a chance you could become frail? 99.9% of people would say yes, definitely. If I live long enough, I'm 27 years old, probably the best health of my life. And I definitely know that if I live long enough, I will become frail. And then what scares you most about long-term care? Just exactly what Mr. Berry said, having to have your family put their life on hold to have to come care for you.
You know, one thing about that too, Reid, is that, you know, a lot of our clients move from New York and New Jersey. So, and their children, and listen, if they've got 3 children, they've got one child that'll step up to the bat and they'll say, hey, mom and dad, don't worry, we'll take care of you. Well, first of all, to you watching that have moved from New York to here, do you really want to go back to New York and back to the snow, or New Jersey, or wherever you came from? Most of you don't. You want to be here. And by the same token, you do not want your children to put their life on hold to come and try to take care of you. So that's why I think we really need to drive this home, Reid, and make sure people really understand what their options are.
Yes, sir. So if you need long-term care, where would you like to receive it? Most people say at home or at a nice facility. Who would you like to provide it? Most people say professional caregivers. That is their job. That is their title. That's what they're best at. So it's not your family. And then the last question, how would you pay for it? Here's the thing, most people have no idea. Long-term care is not a place or condition. It is an event that will financially, emotionally, and physically devastate blank. Devastate your wife, your child, your significant other. What is your long-term care plan? I don't have one. How many times have you heard that over your career?
I've heard it so many in my career, I can't count it.
And see, here's the thing. In reality, you do have a plan. If your answer is, I don't have one, yes, you do. Because if you have not allocated some of your money for long-term care, you are in essence allocating it all. By doing nothing and having no long-term care plan in place, your deductible is every single thing that you own, and your premium would be all of your income.
Great point, Reid.
When I heard that, that really made a lot of sense to me. Well, what about this? How many times have you heard, my spouse will take care of me? That's my long-term care plan. Well, just like Mr. Berry said, do you really want to put your spouse in that position? What is very crazy about the statistics we're going to share with you is 45% of the caregiving spouses actually die before the frail spouse.
That's how hard it is to take care of somebody, Reid. Most people do not understand the physicality it takes to care for a loved person.
Which is why the next statistic rings true, that 55% of them, well, 80% of them are chronically ill. So the 55% of the spouses, caregiving spouses that don't die, 80% of them are chronically ill.
And you know, I know that's not a good plan. I know there's a lot of people too, because you know we meet them every day. They don't have any choice. You know, this is an expensive problem. You know, it's an expensive problem if you do nothing about it. It's an expensive problem if you do something about it also. And we're going to talk a little bit more about that. And because there's a lot of people that really can do something about it and have that, I guess, a greater peace to know that they're going to get to stay home in their own homes to get that care. I've said this over and over again. I don't want to go to a nursing home. And I don't mean anything negative about them. They don't smell right to me. I just don't, I want to be in my home. And I want a caregiver in my home. And my caregiver is not going to be my wife. I want Jan to love me every day. I want my children to come see me, but I do not want them to have to sit over me. I want them to move on with their life. Reid.
Exactly. I'm glad you brought that up, because when this event happens, your spouse will definitely be involved. They'll be involved with talking to the caregiver. They'll be involved with the finances at that point. They'll be having to do a ton of stuff. It's just the physical needs that the chronic spouse needs. The other one won't have to do that. This question, we hear this all the time. What's your long-term care plan? Oh, my children will take care of me. Well, Mr. Barry, you just mentioned this about the people living up north. So where do your children live? And do they still work? Well, in 20 years, because I say 20 years because the prime age to get involved with the long-term care planning is really anywhere from 55 to 75-ish. 75's on the older end of it. Well, at that point, your children are probably, I don't know, 40-ish, 30, 40-ish. So in 20 years, well, they're going to be working towards their retirement. And then your children will have children. So your grandchildren are going through college at that point. And even if your children could put their life on hold, do you really want them to have to bathe you and care for you?
I don't think people understand this. This is what I think most people envision. This is my perspective here, is you think, okay, I'm going to go back and live with my parents, and she's my children, and they've got a mother-in-law suite, and I'm going to be able to watch TV and still do my thing, and they just need to come check on me every now and then. No, we're talking about you need care, that, you can't go to the bathroom by yourself. Maybe at this point you have dementia. Maybe you're dangerous from a standpoint that somebody's got to watch you so you don't turn on the stove and leave the stove on and burn the house down. See, people think that they're still in retirement when they're talking about people taking care of somebody. No, we're talking about real long-term care issues here.
Yes, sir. I'm glad you mentioned that as well. Well, then people say this, well, Medicare will pay. Well, as of the Balanced Budget Act of 1997, Medicare will only pay for your long-term care when you are rehabilitating, meaning getting better. And then they'll only pay for 90 days of care per benefit period. If the person is still restoring and getting better after 90 days of care, Medicare has a lifetime allotment of days of 60 days. So let's get into an example. Let's say you go in and boom, you have a stroke and Medicare starts paying for your care at a nursing facility. Let's say you stay there for a month, so 30 days, and then the doctor comes in and says, hey, Mr. and Ms. Smith, you're not getting any better. Boom, Medicare stops paying. So you didn't get the full 90 days from Medicare because you stopped rehabilitating. Once you stop getting better, Medicare will not pay, and then you are on your own. The VA will pay. Veterans deserve, in my opinion, every single dime they get, and even they need more so for protecting our country. And I know you're big on supporting the veterans as well as I am. We would not be here without them. So every veteran deserves everything. But what's interesting is that the veteran monthly benefit really isn't that good. So the VA will pay, but at max up to $2,837, and then for the surviving spouse, $1,149 per month. Well, we're going to get into the cost of care specifically in the Carolinas, and it's a lot more than that.
I don't know where they're going to get that. I mean, that's not a whole lot of money for care. So I have no idea how that facility is going to look. One thing that Reid and I do agree on, listen, whatever a veteran needs, they should get. I mean, if they put that uniform on, they serve this country. I think we're seeing a lot of changes with what we have going on in Washington now to make darn sure that we take care of our veterans in this country. That's one thing politically that we all can agree on, and they deserve it, Reid.
Amen. Yes, sir. Amen. Let's look at a few statistics. 70% of the population will need long-term care. 7 out of 10 people will need some form of long-term care. But if you're married, there's actually a 91% chance that one spouse will need care. So if you are married, you've got a 91% chance one of you is going to need it. So we always ask, if we told you there was a 90% chance of rain, would you take your umbrella? No doubt about it. Well, that's what we're telling you about this long-term care issue. If you're married, there's a 90% chance one will need it. Well, the average stay in a nursing home is 3 years. However, 50% of claim today is becoming dementia and Alzheimer's, and the average stay for dementia and Alzheimer's is 6 to 8 years. That is a long time.
A little side note on that too, Reid, is that if you look at Alzheimer's and dementia today, it's in the top 10 in terms of creating death for our retirees. It's steadily rising, surely because of the baby boomers. They're going into retirement, they're getting older. So you're going to see that continue to rise in the future.
Yes, sir. Well, what's really average? Average means that if you're standing in a bucket of ice water and your hair is on fire, then your torso should feel pretty good. It should feel comfortable. So average means a little bit in the scheme of things, but that doesn't necessarily mean a whole lot to you. Because if you're average, we know you're going to need care, but you could definitely be in that dementia and Alzheimer's and needs care a long ways. Why is long-term care such a big deal? Well, we got this silver tsunami going on. There are 10,000 baby boomers per day turning 65, and we love every single one of you, by the way. Every baby boomer will be, or 10,000 per day will be turning 65. That's going to continue until 2030. Think about those numbers for a second. Well, back in the day, in 1930, only 5% of the U.S. population was over 65. Do you think this long-term care issue is going to be a big deal for 5% of the population? No, no doubt about it. It was not. Well, in 2000, 12% was over 65. By 2030, 1 out of 4 people will be over age 65, which is why Bloomberg states that inflationary growth of healthcare is 5.5%.
Why do you think so many nursing homes, even here at the beach or assisted living places, are popping up everywhere? See, there's a big demand for this, and there's always been a big demand for the baby boomers all the way from school. We had to keep build bigger schools, and you've seen this whole, it's like a balloon that just keeps going through over the years. But let me just tell you something. This is big business, and it's going to be a big issue because we just got an older population, Reid.
Yes, sir. And hey, the older population is rocking and rolling with this technology, though. So with the social distancing, I mean, it is amazing how everyone's adapting to this technology. So kudos to the baby boomer generation for that. And let's look a little bit about life expectancy. Men, on average, will live to 86.6 years of age. Women will live to be 88.8. Out of married couples, 50% chance at least one spouse will live to 92. There is a 50% chance one of y'all will live to be 92, and 25% chance one spouse will live to 97.
It's probably going to be the woman.
Yes, it will.
It's probably going to be the woman, Reid.
I read something like 90% of women die as a widow, because that means 90% of the men died before the woman. So that will be the woman, no doubt. Let's talk about the cost of care in the Carolinas, because that's where we focus on in North and South Carolina. Currently, for home care, about 5.5 hours a day is around $45,000 a year. Well, based on the 5.5% inflation we're seeing, by 2025, some good quality 5.5 hours of home care, you're talking $63,000. Well, if that maintains until 2030, you're talking $82,000 a year for home care. And then you see by 2035, it's well over 6 digits. Well, that's not talking about assisted living. That's just for home care. Assisted living, now you're talking around $55,000 a year here. Well, in 2030, just 10 short years away, you're talking $97,000. Nursing facilities, full-fledged nursing facilities, 24/7 care, today is around $75,000 a year. In the Carolinas, what do you think that is up north?
It'd be twice that, probably twice.
Twice that. Up north, way more expensive. 2030 for the nursing home projected to be $135,000. By 2035, you're pushing $175,000 for cost of care in the Carolinas. Those numbers are out of sight, out of mind for a lot of people. So let's get into the ways to pay for care, because realistically, there are three ways and three ways only. You can either be a self-funder, meaning you're going to pick up the bill by having no plans, by not purchasing long-term care insurance or not doing anything else. What you're saying is, hey, I'm going to roll with it. I'm a self-funder. The second way, you could go on Medicaid. So not Medicare, Medicaid. And then the third option is to buy long-term care insurance. So we're going to dive into all three of these. Should you self-fund? Mr. Berry, what do you think?
Well, I didn't do it. I've been very blessed. I think Jen and I have enough assets that we probably could have. But, you know, why? I mean, listen, the purpose of insurance is to mitigate losses. When you look at some of the billionaires out there like Warren Buffett and Bill Gates and some of those people I think are very smart minds, these are people, you know, especially Warren Buffett, you know, he owns Geico. So he bought long-term care insurance. Well, why did he buy long-term care insurance? Because he wanted to mitigate his losses. He understands that he's got to pay a certain amount out of pocket, like a deductible, Reid, but he doesn't want to carry the whole thing. So what he's done, he knows that he's limiting his exposure in terms of what his estate will have to pay.
Right. And so when you're looking at care, assets don't pay for care. Income pays for care. What do I mean by that? These home facilities, assisted living facilities, nursing facilities, they don't care how much money you have. They don't care if you got $2 million, $5 million, $10 million. No, all they care about is, hey, I'm coming in per month. Can you afford the $5,000 to $6,000 a month for me? That's all they care about. The nursing facility, hey, I don't care if you got $2 million. Can you afford the $10,000 a month to get care? If you can, we'll care for you. So for the people that got rocking Social Security checks and rocking pensions, we've got some clients that come down from up New York and Maine and Vermont, and they got pensions that are $50,000 to $120,000 a year. They're rocking this place, and they probably don't need as much long-term care as somebody who's just living on Social Security and then drawing down a lot of their assets. So do you pay for car insurance? Less than 18% of people ever file a claim on car insurance. Do you pay for homeowners insurance? Less than 5% of people ever file a claim on their home. But do you pay for long-term care insurance? Because there's over a 70% chance you'll file a claim on this. And here's the other thing about being a self-funder. The majority of Americans have their monies in pre-tax accounts. Well, so when you pull monies out to pay for care out of your IRAs, 401ks, 403bs, TSPs, profit sharing plans, not only will you increase your taxable income, you'll owe more tax and actually receive less money. So can you really afford another $7,000 to $9,000 bill every month? Well, me and Mr. Berry were discussing this, especially with all this market volatility. If you got $1 million in a pre-tax account, in a retirement account, that's 7 digits. That's a lot of money, no doubt about it. Well, what if it was all exposed in the stock market and you lost 35% of it with this market downturn? Now you're down to 650. And then now let's say you got to pull another $80,000 to $100,000 a year to help pay for care. You're really only netting around $50,000 to $60,000. You just lost half your account.
You're going broke. I mean, you know, that's the thing, Reid, I tell people, you know, you see me in a bunch of appointments. One thing I'm real big on is being gracious to people, but telling people not what they want to hear, but what they actually need to know. And sometimes I think people come in here and they think just because they got $1 million, Reid, that, oh my gosh, that they're set for the next 35 years. $1 million is still a lot of money, but $1 million is not a lot of money carrying you for the next 30, 35 years, especially when we start talking about healthcare issues like we're talking about now.
Right. And another thing is times are changed with interest rates. You know, back in the day, if you had $1 million, if you could get 6% in the CD, you got it made in the shade. Well, now CDs are paying less than 1%. So $1 million, not only are you reducing your principal by pulling monies out, you're reducing future interest, and you got to pay Caesar's what is Caesar's with the taxation. So like Mr. Berry was mentioning earlier, Warren Buffett and Bill Gates can self-fund. Don't you think? They both bought long-term care insurance because they understand risk exposure. How does Medicaid work? So now we're on option 2. How does Medicaid work? Well, if you're single, they will make you spend your assets down to $2,000 in assets. They will give you $30 of income per month. $30. That's not $3,000. That's not a typo. That is $30. They will take the equity in your home, and they will take the equity in your automobile. $2,000. Well, if you're married, they'll give you up to $68,480 in assets. They'll give you just shy of $3,000 a monthly income to help pay for bills and things like that. They'll let you stay in your home as long as the equity is less than $500,000, and they will give the community spouse a vehicle. So for the people that are married and getting care, they still, if you go on Medicaid, yes, the living spouse will still be able to have a car and still be able to live in the home while you're alive and while you're getting care. But see, when you die, when the person getting care dies, now the living spouse is now a single father. Then when you've just basically made her or him indigent, meaning you spent all your money for care, now you're leaving them with nothing at your death, and then they are going to go on to Medicaid and spend their assets down to $2,000.
You know, one thing about this too, a lot of people think too, when they have good assets too, they says, well, what I'm going to do is I'm just going to put my assets in a trust, and you know, I'm gonna let Medicaid pay for me. Well, there's a 5-year look back on this deal. And think about it, you're just not going to give your assets away, because Reid made a great point a few minutes earlier. Most of the retirement assets that we see, the substantial assets, are pre-tax accounts. They're 401ks, they're IRAs, there's 403bs, there's TSPs. So think about it, if you got a $500,000 IRA and you say you're going to give that away, then all that's going to be taxable in that year if you give it away and put it in a trust. And so what you've done too, by giving your assets away, you've lost you've lost your financial well-being, your security. So that's not a good play for most people. The people who are getting Medicaid, Reid, are people who deserve it and need it because they have not been blessed to save and build the assets that most of the people that we talk to.
So giving your money away, you can give it all away, but just like Mr. Berry mentioned, you got to put it in an irrevocable trust. However, you have to do this 5 years before you go on Medicaid, or they will use the look back period and still get the monies. Mr. Berry, how did this work out with Mrs. Berry's grandmother?
Yeah, Jan's, my wife's grandmother was basically in a nursing home for a little over 10 years. And once she passed away, she's been deceased now, Reid, I don't know, maybe 7 or 8 years. We've got the government's now coming back against her estate, and they're trying to force a sale of her farm to recoup all the monies that they paid out. So your assets aren't safe here. You know, I tell people too that are here, and this is a good strategy for a lot of people. Those of you who are living here at the beach and you think this is going to be your home forever, well, you could actually change the title to your house to your children and still put it where you get lifetime estates to the house. And that way, if one of your kids start getting crazy, they can't sell the house out from under you. But as long as you and your spouse die after 5 years, see, that asset's totally protected, Reid.
Wow, that's a great strategy, and you've helped a ton of people with that. And then an overwhelming question: do you really think the Medicaid homes will be as nice as the private pay facilities? No. And you know, we hear about people now who have been on private pay. They were paying in a nice facility, and they spent all their money, but then now they're on Medicaid, and then now Medicaid is helping pay for that same facility because they're not kicking them out. We hear about that sometimes too. And so a lot of people will say, well, why would I pay all this money to get care or long-term care insurance when the Medicaid people get the same amount of care? That is very rare for that person to happen. And with 10,000 baby boomers per day coming towards this silver tsunami train we got going on, that won't be able to happen in the future.
I want to say something. Listen, businesses exist to make money, Reid. And you better believe that this long-term care facility, that they want the people who've got the money that can fork up the checks, and they want people who want their loved ones in some of the best facilities that are out there. And that's who's going to fill up those beds first. I hate to say it, And this is not me, but this is really how it works. Money does talk when it comes to care.
Yes, sir. So now let's get into the long-term care insurance, because there are two types of long-term care insurance. The ones on the left, the column on the left, is traditional long-term care insurance. This is like your term life insurance. This is like your property insurance. This is like your car insurance. Premiums are not guaranteed. What does that mean? That means that they can increase your premium. Mr. Berry, in your 30-something year career, how many traditional long-term care premiums have you seen increased?
Almost everyone I have ever reviewed, I've seen a rate increase. And what's kind of becoming the normal is you can see a rate increase from 50 to 100%. And get this, it's not that these insurance companies are just out to kind of get you. The problem is that these insurance companies didn't price this earlier on when this first came out. What they really thought the retirees were going to do, Reid, is they thought they would carry this long-term care insurance for a while and they would drop it. So the insurance industry thought the lapse ratio would be a lot higher and they just get to keep those monies. Here's what's really happening. These retirees are taking these policies to the grave and they're filing claim on them, and these insurance companies are paying a ton out. And this is not picking on any company, but two of the big players in this arena are Genworth and John Hancock. I've seen both of those companies, and you have too, Reid, to raise some clients that they're clients of ours, but not long-term care clients. They've raised their premiums 100%. Because when you're losing $800 million in a quarter, they're going back to the insurance commissioners and they're saying, hey, either you let us raise premiums or we're not going to be able to pay these claims out in the future and try to make a profit. So they're in between a rock and a hard place here.
Yes, sir. And with the traditional policies, there's typically a limited pool of money. What does that mean? You may have a policy that gives you a $200,000 pool of money. Well, that's a spit in the ocean when we're talking about care being $80,000 to $90,000 a year. And so what happens is once that $200,000 is spent, you're on the hook again. You bought a Band-Aid. There's no death benefit, meaning you buy this policy at 55 years of age, and let's say you live to be 90 years old and you paid every single year, and then boom, you drop dead and you never file a claim. You lose everything. Your family gets nothing of that policy. You typically have to pay it for life, meaning you literally have to pay it until the day you die, and there's no cash value, meaning let's say again, you buy it at age 55. You've been paying, let's say you funded 80 grand in here, and 15 years from now, you need to pull some monies out of it. Not from this policy. This is like your term insurance. So then it brings up the hybrid and the asset-based long-term care insurance. By far our favorite. I know I've got the benefits listed below, which we'll discuss. But Mr. Berry, I know you own an asset-based long-term care policy. When did you hear about it, and what was attractive to you about it?
Well, I heard about it when my wife told me about it, and I bought it because she told me to buy it. And I knew I was going to buy it because of what we went through, again, with my parents. And so, this stuff is important to me. Listen, most of the people that typically focus and do long-term care planning, Reid, they're the people that care for loved ones. They know how hard this stuff is, okay? But I didn't want what is on the left side of this page, traditional long-term care. I didn't want all those uncertainties. I wanted to know what my benefits were, that my benefits couldn't go down, that my premiums were guaranteed not to increase, and that even if I didn't live long enough and Jen and I never filed for claim, my family would still be able to reap what I put in. And so I think this is why people are really going to this plan. It's why I bought it, because there are no surprises.
Wow, no surprises. Your premiums with an asset-based long-term care policy guaranteed to never increase. Some have unlimited monthly benefits. So the way these plans are designed, they look at your monthly benefit. Do you want a $3,000 monthly benefit, a $5,000, $8,000, $10,000 monthly benefit? Meaning if you need care, that will be your benefit. Well, some of these hybrid policies have unlimited, meaning they pay that $4,000, $5,000, $6,000, $7,000 as long as you need care, unlimited. There's a death benefit in case you never use it. It can typically be anywhere from 75 to maybe 150% of what you put in some cases. The beautiful thing about this is you can pay it all in one lump sum. I mean, it is amazing. You stroke one check, you got money sitting in the bank earning 0.5 that's going to not pay anything for care and not earn and depreciate due to inflation. You could take that money, put it in an asset-based long-term care policy, and get an unlimited monthly benefit as long as you need care. And then the cash value to use as an asset. You can literally pull monies out of your long-term care hybrid policy in case you just had to get your hands on some monies. How do you qualify for care? So this works the same with either policy. I just want y'all to know. How do you qualify for care? You have to meet two things. The first being a cognitive disorder, meaning you've got Alzheimer's, dementia, or short-term memory loss. A little side note too, for some people that have traditional long-term care policies that they bought back in the 90s or maybe early 2000s, some of those policies do not cover cognitive because they didn't see it as a big deal. So if you have a traditional policy, make sure that thing covers cognitive, or you may need to look into something else. Or the second thing is physical. You have to have the inability to safely perform two of your activities of daily living, which means eating for yourself, bathing for yourself, dressing for yourself, toileting, getting up and down off the toilet, transferring from room to room, stuff that if you live long enough and I live long enough and Mr. Berry lives long enough, we will have trouble. I know after Mr. Berry plays tennis, he sometimes has trouble transferring from place to place.
That's because I play so hard, Reid. You know that.
You're good for sure. But that is a big deal. You have to meet two of these things, either the cognitive or the physical. And your doctor determines that. Your doctor is the one who determines if you have trouble safely performing or you've got a cognitive disorder. Now let's look at a example of an asset-based joint policy. That's what's amazing. For those of you that are married, you can buy a joint policy and they give you a huge discount. If you're single, it's still going to be less expensive than a joint because now you're on the hook for one person. But if you are married, instead of having to pay a fortune for two policies, you could get a joint policy. Let's say we've got two 65-year-olds who want a $5,000 unlimited benefit per person. Meaning if you need care and you have trouble performing two of your activities of daily living, or you have a cognitive disorder and you file a claim on it, then boom, you've got a $5,000 monthly benefit to pay for care as long as you need care. That's $60,000 a year. That's a big deal. Or if you both need it, that's upwards to $120,000 a year. You know what's beautiful about these long-term care policies too? Is that monthly benefit is tax-free. We just saw how it's a huge issue with all these past webinars we've done, with taxes going up, with the stimulus, with people living longer, tax rates will go up. So instead of having to draw down your biggest pre-tax retirement account and get killed by the IRS, if you've got a long-term care policy, that monthly benefit is tax-free. How much would $120,000 of unlimited tax-free care cost you? If you do a lump sum, it'd be $154,000. Oh my gosh, let's think about that. $154,000 one time, you never put another dime into it. That gets you a $60,000 per person unlimited benefit. Here's the beauty thing. What if you die and never need care? Your family gets $166,000. How much did that cost these people?
Around 10 grand.
Well, they actually were gravy to the 10 grand. They put in 154, but then if they die, their family gets 166.
See, that's why people mostly don't like long-term care, because they have the traditional plan, Reid. And what you do is you pay. And if you don't use it, what happens?
You lose it.
You lose it. See, somebody's going to win here. That's what I love about the plan. I bought it for Jan and I bought it for her mother and her husband. The thing about it is, if I need care, great, I get it. If Jan and I die and never file for care, my family still gets the value back. So there's no scenario here for me that my family can't win with this plan.
Yes, sir. That's why we call it a win-win-win. If you need care, it pays. If you don't need care, then your family gets what you put in. And then the third win is that it's unlimited and tax-free if you use it. Well, what if you say, Reid, I don't have the lump sum. I can't do that. Well, you can pay it up in 10 years. It would cost $19,755 a year for 10 years. So what's that mean? Over 10 years, if you will have put in $197,550. However, your annual benefit is still the $60,000 or $120,000 if you both need it. Well, some people say, well, Reid, what if I get into this 10-year plan and 6 months from now I have a stroke? Will it cover me? Yes. Yes, it will. That's why the sooner, the better you can get this in coverage. I've got a disability policy that I know if I get disabled driving home tonight or doing something crazy, then it covers me. That's a big deal to me because the same exact situation. No, I'm not 65 years old necessarily thinking about long-term care, but strokes, accidents, they happen all the time. And the minute you get this policy in force, you are covered. That is a huge peace of mind play. You can go out to 20 years. If you don't have the cash flow to do it in the 10 years or the lump sum, 20 years, they reduce your premium to $12,652. Over 20 years, you'll have put in $253,000. If you die and never use it, your family still gets the $166. I'll put this down at the bottom. Prices are based on age and health. That is a huge deal because I would say with 3,000 wonderful clients at age 65, no exaggeration, probably 75%, 3 out of 4 people that apply for this either get rated, meaning they got to pay more for the same benefits, or they just get straight up declined. So you could have $5 million that you're just begging to put into a long-term care policy. But if your health is messed up, you won't get it. What do I mean by that? If you've had a stroke in the last 6 months, you got some serious heart issues going on, if you've got some real serious health issues, they may not accept you. This is an insurance-based product. And the other thing is you don't know until you know. We've seen people that we for sure thought would get the coverage and then boom, get declined. And you feel bad for them. These people miss the boat because these insurance companies want you in the good times so they can take care of you in the bad.
By the way, too, if they look at these numbers, Reid, you can see the insurance company gives you a big discount when you do it up front because they got more of your monies to use. And it's not that everybody can do that. Are you going to go into, or do you talk about required distributions at all? Is it part of this presentation? I'm going to make that statement here. By the way, some of you are taking your required distributions because you're over 72. And a lot of our clients say, well, Richard, I don't know. I don't need this money. I've got my pensions and I've got other monies. What do I do with my required distribution? This is a good thing to do right here because you can take that distribution that you're already paying taxes on, and what you can do is you can fund long-term care. That's if you don't need it for income and if you're insurable to do it. So a lot of our clients do it that way, Reid.
Yes, sir. No doubt about it. And when you're looking at rate of returns on money, because see, some people already have monies in the bank. We hear it all the time. Hey, I've got this $150,000 in the bank for an emergency fund, or like, in the back of your mind, and everybody needs an emergency fund, but in the back of their mind, a lot of times they're saying, hey, holy smoke, I need to keep this here in case I have a serious health scare. That's what this long-term care will pay for. If you have a serious health scare, Medicare will pay for it while you're getting better or for the major health and thing. And then if that stops, you've got this long-term care benefit. So if you put $154,000 in, and then let's say 6 months from now, God forbid you have a stroke and you need care, they'll give you $60,000 a year the rest of your life. Where can you get that rate of return on any type of investment if you need care? Nowhere else. Long-term care, 70% of population and almost predictably 100%, at least one spouse will need care. 2/3 of people who live to be 60, 2/3 will live into their 90s, according to Duke Medicine. Once again, 45% of spouses who are the caregiver will actually die before the spouse who originally needed care. And of the surviving 55% of spouses, 80% will become chronically ill. In many cases, a married couple will have to liquidate so much of their assets for the one that needs care that the surviving spouse can no longer maintain their financial independence. Long-term care is much like life insurance and disability insurance. It's a love gift for the insured's family and loved ones. Mr. Berry, that's what you've been discussing the whole time. 6 key considerations we want to leave you with. How do you want to receive care? Where do you want to receive care? Who do you want to provide the care? How will your family or yourself pay for the care? How do you feel about your current long-term care plan? How would you feel if you invested in an asset-based long-term care plan? I can just tell you, you'd feel amazing. That's how I feel with my life insurance and my disability insurance, because I've got that peace of mind. Mr. Berry, I'm sure that's how you feel.
There's no doubt about it, Reid. Again, I just don't want to. I don't want to be a burden to my children, and that's the viewers. You know, I'm 55 now. Everybody that's watching this tonight, that's exactly how they feel. They do not want to be a burden on their children. We teach our children our whole life about being independent. We teach our children that they all have greatness in them and where that greatness comes from, which is not because of them. And, you know, we want them to succeed and do well, right? And I don't want my children to have to take care of me, Reid.
78% of people have not communicated their long-term care desires with their spouse, family, or children. And why is that? Because there's a direct correlation between how difficult a subject is to talk about and how important it is to have that talk. I personally don't like to have tough conversations. That's just me. I don't like it. However, it's that important conversation you need to have. You need to know if you need care, if your spouse needs care, what are the plans? What are the options? Perhaps the greatest benefit of long-term care insurance is it can allow loved ones to care about you instead of having to care for you. Long-term care insurance is designed to protect your family from a financial, physical, and emotional disaster. Purchasing long-term care insurance could potentially be one of the greatest decisions that you ever make. www.barryfg.com/schedule meeting. www.barryfg.com/schedule meeting if you're interested in having the long-term care discussion to see if you can get approved, to see if it's right for you. This is my wife and my beautiful dog. I should have said my beautiful wife and my dog is what I should have said. I think they're both beautiful, though. I'm the most blessed person you'll ever meet. These are my beautiful in-laws and their beautiful dog. Next Thursday is going to be awesome because Thursday, April 16th at 6 p.m., we're going to introduce a specialized service where we focus on market-based strategies that still reduce risk. So Thursday, April 16th, specialized service we're introducing to focus on market-based strategies that still reduce risk. What's awesome about this is we're bringing the Chief Investment Officer of Alpha Star Capital Management. This gentleman has been over a company that invested over $12 billion. $12 billion with a B. This guy looks at the markets daily. I'm very excited for his knowledge. And then a good buddy of mine with Brooks Riley, investment advisor consultant, he's helped me and our firm with our knowledge about some of these market-based strategies. What's amazing about these market-based strategies is that they still reduce risk because Berry Financial is about risk mitigation and preservation.
And that'll never change, Reid, because of the age group that we work with. What we understand is that there's a lot of our clients, too, that want the lion's share of their money secure, but they also want a little bit more opportunity, too, but they don't want to step out there and take on a 30% loss or 40% loss, so they still want to mitigate those losses. This is what this presentation will be about.
Exactly. So next Thursday with Alpha Star Capital Management, We've got some really cool people coming on board to talk to us. We're going to talk a little bit about the Beta Shield strategy. You need a risk mitigation plan. And so for the people that are willing to assume risk and willing to assume negative returns in down years, but still mitigate those losses and have more potential upside, this may be for you. So you definitely want to hear them talk about this next week. And invite a friend. Please forward these webinar links to your friends and family. We'll give you a referral credit for maybe extra tickets to our client appreciation event, maybe gift card opportunities. Make sure they put their name or your name down when they sign up so we can give you those credits. There's a lot of people that are interested in helping their friends, and that's a big deal to us, and we can't thank you enough for those referrals. And so remember, www.barryfg.com/schedule meeting to have some of these conversations. And Barry Financial has been giving retirees and pre-retirees peace of mind through safety since 1987. We love every single person on here tonight. Thank y'all for joining. It's been our pleasure. And
God bless.
God bless. Y'all take care and stay safe.